Devesh, good morning. Thank you for joining us.
Good
I have
morning,
some
Push.
friends who've invested in your company and they tell me the following that Fusion Microfinance has everything going for itself, but when they will become a bank, there would be a migration cost, there would be challenges in the short term, and that is something which you need to be cognizant of. Where is the franchise headed? And when you jump from being a microfinance company to a bank, will that change come at a cost?
So, good morning. I don't know where you have heard this. So, right now, there is no such proposal on the table. We are very focused as a NBFC MFI, microfinance remaining our core. We have now 4 million, close to 4 million customers. We are in 22 states. We are doing well. And then, we are also building our franchisee to serve customers in other products. We started MSME. MSME is now around 5.5%. We are doing more of secured assets. So I think right now we are not distracted. We are not looking at any such proposal. Our idea is to build this franchisee, build more products, build more resilience, work with our customers, do a lot of work on technology. We have now in-house tech team. A lot of work is going on there. So I think right now our focus is to be more resilient, sustainable organization and move forward with our customers. There's no plan of either a small finance bank or a bank right.
So I don't want to get this one wrong. Now, you have no plans to become a bank anytime soon. Can I assume that?
Yes, you're absolutely right.
Let's understand that how are you planning to bring growth and how are you looking at maximizing from this entire focus area of yours, which is the MSME vertical?
So a good point, Nikunj. So one, if you look at our journey of last 13, 14 years, the first phase of our journey was more about diversification, having a taste of all the geographies, because in this sector, diversification is important. So we are now one of the most well-diversified company, more than 400 districts, 22 states. 2 years back, I think we started our second phase of journey where we said, now we are well diversified, let's mine deeper. That is what is happening. We are now opening more branches in our core geographies and some of the new states we have entered in the last 2-3 years. And correspondingly, we said we should also be ready with other products because we have advantage of being with the customer. Same household is taking a MSME loan, maybe wanting a affordable housing loan. So how can we, adjacencies, what we see, how can we harness those adjacencies? So with that in mind, we started this pilot in 2019. We are very happy. We are now close to 100 branches. We are in 7-8 states. And also, Nikunj, looking at the risk, we have started this convergence project last year where microfinance customers were graduating and wanting a larger loan. With some kind of security, we are moving them to MSME so that we don't want to do very large unsecured loans through our MFI book. So I think this is also coming out very well. I think all our strategies are in place. It really puts us in a very advantageous position because of the geographies where we are in. We are rural. Looking at the thrust of the government will be more. The first thing Mr. Modi did was to sign that installment for the farmers. Yesterday it is about the housing. So this whole rural, I think, consumption boost will happen, and which will really gives us a confidence that by being present there, we can really be in a good position to serve the customers better.
Right. Let's also understand a little bit more about what the outlook is in terms of your diversification. Would that make it viable then for achieving an ROA in the range of 4.7 to 4.9% and an ROE of about 18 to 20% that had been guided by you in the analyst meet?
Yes, so you're right. So we have been guiding this kind of ROA and ROE in spite of the fact that we are one of the lowest cost to our customers. We have kept the sensitivity of the regulator in mind. So we are very confident that even if we are growing, in mid-20s, we want to be growing at a very calibrated manner. Even if you look at today, we have 4 million customers. My outstanding per customer is still 28,000. We are not burning the ocean as far as the ticket size is concerned. We are very calibrated, as I mentioned, to Nikunj, that larger loans will be done with more cash flow analysis, right businesses, some kind of security, rather than just giving the large, unsecured loans to our customers. So I think this gives us a confidence that we'll be able to achieve. If you also see the NIM has been expanding. We believe that we will try to maintain around 12% of NIM. Our cost of fund, if you see last year, one of the very few companies where we got 2 rating upgrades, cost of fund has been coming down. So all these things gives us confidence that we will be able to give a sustainable, ROAs of this range and ROEs of around 18 to 20%.
You'll appreciate the spirit of my next question, which is that right now there is a war of liabilities and banks are struggling to get liabilities going. So for you to, let's say, borrow from the wholesale market will get even more difficult. And if cost of borrowing is structurally higher, that means your cost of lending would be higher. And if cost of lending is higher, that means the concern of unsecured and default and loan payback, loan servicing could be a concern. Is that a valid concern which I'm flagging off?
So, Nikunj, if you look at us, so even all the lending which we've got, in spite of 250 bips increase in this rate cycle by RBI, our cost of fund has been going down. I think primarily it is because of the fact that, because we are a very well-established franchisee, strong balance sheet, rating, our engagement with the lenders, and we are very quality franchisee. So I do not see any, challenge. I can tell you, even last quarter, our cost of fund, final cost of borrowing was lower. So we are, I think, some of the top lenders have, some of the very conservative lenders like HDFC, Kotak, ICICI, all of them have one very large exposure to Fusion. So I don't see any risk there. However, over the next 3 years, we already have a plan that how do we diversify our borrowing by, we have just closed our DFC $25 million 8-year money at a very low and overall lending cost of less than 9%. So we will be looking at some of the other instruments, but I do not foresee any kind of challenge because it's still a PSL. What we are talking about is risk weightage, which was increased by RBI, microfinance, and housing loans, some of these sectors which are very key to the bottom of the pyramid or for inclusion. They have been kept out of it. And we being a very established franchisee, I think that's a better range.
To have you on board. Thank you for taking time out and joining in. That's the management from Fusion Finance talking about how they're confident of achieving a calibrated growth in the mid-20s and will focus on maintaining their net interest margins at.
If you like this video, then like, share and subscribe to ET Now.